Welcome back to the Deep Dive. Today we are looking at something that, well, on the surface might seem a little beige. We are talking about U.S. Bancorp.
Right.
And I know regional banking isn't usually the stuff of thrillers. You expect steady, predictable, maybe even boring numbers?
It's the quintessential SCADE industry. Usually if a bank is in the headlines, it's for all the wrong reasons.
Exactly. But here's the thing. We just got our hands on their Q4 2025 earnings report, which came out January 20th, 2026. And boring is absolutely the wrong word.
Not at all.
The numbers tell a story of a massive pivot. It's like watching a cruise ship suddenly turn into a speedboat. It's not just about saving pennies anymore. They are getting ready to spend money to grow.
It really is a fascinating turn. I mean, if you just look at the headline numbers, they tell you something is working. Earnings per share, or EPS, hit $1.26.
And the expectation was what, $1.19?
Only $1.19. And revenue, a record, $7.4 billion.
A record. And that's the mission for this deep dive. We aren't just reading a balance sheet here. We want to figure out how a traditional bank is managing to grow fees, buy up trading firms, and, get this, test out cryptocurrency.
All while keeping their expenses flat for 2 years. It's a balancing act that very few institutions can pull off.
So let's unpack this. The first thing that jumps out from the report is this term, operating leverage. It sounds like something you'd need a physics degree to understand.
It's a bit of a buzzword, yeah.
But they make a huge deal out of it. Meaningful positive operating leverage of 440 basis points. Okay, translate that for us.
It's the holy grail of banking efficiency. Simply put, it means your revenue is growing faster than your expenses.
Okay.
Imagine you get a, let's say, 10% raise at your job, but your rent and your grocery bills stay exactly the same. That gap between what you make and what you spend, that's the leverage.
And the wider that gap, the more profit you keep. So revenue went up, but costs didn't chase it.
Precisely. And 440 basis points is a very healthy gap. That's 4.4% of pure efficiency gain. But what makes this truly impressive for U.S. Bank is the context.
The fact they've done it for so long.
For 9 straight quarters, they've kept expenses largely stable.
9 quarters. That's over 2 years. I mean, think about the last 2 years. We've had inflation, wage pressure, tech costs spiraling. How do you even do that?
You'd think it would mean cutting into the bone.
Right.
But they credit what they call signature productivity programs. Essentially, they spent the last few years aggressively automating back-office tasks, digitizing everything, just taking the friction out of the system.
But here's where it gets really interesting. The plot twist for 2026.
Exactly.
Because usually when you hear cost control and efficiency, you think, okay, brace for layoffs. They're tightening the belt.
But CEO Gundam Kadia is signaling the opposite. She's basically saying, we've done the hard work of tightening the belt. Now we're going to spend.
So they're shifting gears.
A major shift. Investing in technology, in sales, in marketing. They are pivoting to growth.
That is a confident move. It's like they spent 2 years building a really efficient engine, and now they're finally ready to step on the gas. It implies they aren't worried about a recession.
They're playing offense. Which, brings us to the question of where the money is actually coming from. If they're ready to spend, they must be generating some serious cash.
Right. A bank has 2 main engines, lending money and charging fees. Let's look at the lending side first. Net interest income, or NII.
This is the core business, right? You take in deposits, you pay a little interest, you lend that money out, and you charge a higher rate. The difference is the net interest margin, or NIM.
And their NIM is up.
Up to 2.77%, with the stated goal of hitting 3% by 2027.
3% is a pretty aggressive target for a bank this size. But to hit that, you need people to actually borrow money. I feel like all we've heard about is a credit crunch.
Well, the data suggests that crunch might be easing, at least for U.S. Bank's clients. Their commercial loans are up 10.1% year over year.
Double digits. That's not just stabilizing, that's real expansion.
It's a massive signal about the broader economy. You have to think about what that represents. A business doesn't take out a loan at these rates just to let the money sit there.
No, they're buying inventory, building a factory, hiring people.
It's a sign of economic optimism. Even their credit card loans are up 5.7%.
Okay, so the demand for loans is there. But let's flip the equation. To lend money, a bank needs to have money. And I saw something in the report about them reducing CD counts by $6 billion. Why would they get rid of certificates of deposit? Isn't that guaranteed money for them?
It is, but it's expensive money. If you walk into a bank and buy a CD, the bank has to pay you a pretty high interest rate, maybe 4% or 5%.
Right, that eats into their profit margin.
Exactly. So U.S. Bank is strategically moving away from that. Instead, they're laser focused on what they call consumer and operational deposits.
Which I assume are cheaper.
Much cheaper. Think of your primary checking account. You probably have your paycheck direct deposited there. You pay your bills from it. You likely earn almost zero interest.
Right. I think I get 0.01% or something insulting like that.
Exactly. To the bank, that is incredibly cheap capital. If they can get you to use them as your primary bank, they get your money almost for free, and they can lend it out at 7% or 8%.
And that spread is where the real profit is.
That's the sweet spot.
So that explains the push for this Bank Smartly product I saw mentioned. It sounded like just another marketing slogan to me.
It is marketing, but it's targeted. Bank Smartly is designed to attract younger, more affluent clients who actually stick around. These aren't the rate chasers jumping from bank to bank for an extra 0.5%.
They want a good app, good service, convenience.
Right. And once U.S. Bank captures that checking account, they have the foundation to cross-sell everything else.
Which leads perfectly into the everything else, fee revenue.
Yeah.
Because you can't just rely on interest rates, right? They go up, they go down.
You need a baseline. And that's where they're showing their diversity. Fee revenue grew 7.6%. This proves they aren't just a lender. They're making money from payments, trust services, commercial products.
A one-stop shop. It dampens the volatility. If interest rates crash tomorrow, they still make money every time I swipe my card.
Precisely.
Speaking of being a one-stop shop, we have to talk about the big news in this report, the acquisition. U.S. Bank is buying a firm called BTI.
Yeah. This is a significant strategic move.
I had to look them up. BTI is an institutional trading and investment banking firm. Equity trading, prime brokerage, IPOs. Why would a regional bank want to own a trading floor? It feels risky.
It definitely raises eyebrows. It feels like 2008 all over again.
I bet.
But think about the life cycle of those commercial clients we just discussed, the ones growing at 10% a year.
Okay.
Today, that client needs a loan to build a factory. U.S. Bank provides it. But what happens in 5 years when that company is massive?
Yeah.
They don't need a loan. They need to issue stock. They need to sell bonds.
And if U.S. Bank can't do that for them?
The client walks across the street to Goldman Sachs or J.P. Morgan,
Yeah.
and U.S. Bank loses the entire relationship.
So buying BTI is a defensive play. It's to ring-fence their best clients.
It's so they can say, you don't need to leave us. We can handle your IPO right here.
So it's about keeping the client in the ecosystem.
Yeah.
But what about the culture? I mean, you have buttoned-up commercial bankers in Minneapolis, and then you have the high-energy trading floor guys. Those two worlds don't usually mix.
You are absolutely right, and history is littered with failed bank brokerage mergers. It is a huge risk. But CEO Gunjan Kedia made a very specific point to address this. She emphasized that they haven't just met BTIG, they've been partners for 10 years.
Oh, 10.
They've already worked on over 350 deals together.
Okay, so they've been dating for a decade, and now they're just getting married.
That's a great way to put it. It's not a cold acquisition. They know how the other side works. And financially, it's a bolt-on deal. It only impacts their capital ratio by 12 basis points.
Which is tiny for a bank this size.
Negligible. It fills a specific gap without betting the farm.
It's interesting you mentioned betting the farm, because looking ahead in our outline, I see the word crypto. And usually when I see regional bank and crypto in the same sentence, I get nervous.
Yeah, that's fair. It brings back some bad memories from a few years ago.
But this seems different.
It is fundamentally different. This isn't U.S. Bank buying Bitcoin on their balance sheet and hoping the price goes to the moon. They are piloting a program for cross-border stablecoin transactions.
Okay, let's unpack that. What does that actually look like in practice?
It's about plumbing. It's about infrastructure. Right now, moving money across borders is slow and expensive. You use the SWIFT network, it takes days, everybody takes a cut.
Right.
Stablecoins, which are pegged to the dollar, can move instantly, 24/7.
So U.S. Bank isn't viewing crypto as an asset to speculate on. They're viewing it as a technology upgrade.
Correct. They have a dedicated digital assets and money movement group. For them, it's just a better way to move value from point A to point B. It's utility, not speculation.
But there's another layer to their crypto strategy that I found even more fascinating, the global fund services business.
This is the part that doesn't get enough headlines, but it is massive. In 2025, U.S. Bank onboarded nearly half of all new U.S. ETF launches.
Wait, 50% of the entire market?
50%. It's a dominant position. And recently, a huge chunk of those new ETFs have been digital asset funds, Bitcoin ETFs, Ethereum funds, and so on.
And U.S. Bank provides the back office infrastructure.
The administration, the custody services, all of it.
So they are the picks and shovels provider for the crypto gold rush.
Exactly. If Bitcoin doubles, U.S. Bank makes money on fees. If Bitcoin crashes, U.S. Bank still makes money on fees. They've found a way to profit from the ecosystem without taking the direct risk of holding the coins themselves.
That is smart, the ultimate hedge. But it's not all victory laps. Every earnings call has a scary section, and for banks, the villain is almost always the regulator.
Or regulatory drama, as we might call it. Yeah, there's a looming threat discussed on the call about a proposal to cap credit card late fees or even interest rates.
I saw the CEO's quote on this. She did not mince words. She said a 10% rate cap would be crushing.
Very direct. She estimated it would be crushing for 50% of their clients and detrimental to over 90%.
Explain the logic there. If the government caps rates, isn't that good for the consumer?
The bank's argument is about access to credit. If a bank can only charge 10% interest, they simply cannot afford to lend to anyone with a less than perfect credit score. The risk is just too high for that low of a return.
So the people the regulation is trying to help.
Would actually get cut off from the system entirely. The bank will just stop lending to them. And that forces people toward predatory lenders or payday loans.
So aside from complaining about it, what is U.S. Bank doing?
No, they're improvising. They launched something called the Shield credit card. It offers 24 months of 0% APR.
2 years of no interest. That sounds like they'd lose money on it.
Short term, maybe. But it's a strategic move. It allows them to say to regulators, look, we are the good guys. We are offering a product to help people pay down debt. It's a defensive product.
It's proactive. Regulate yourself before someone else regulates you.
Exactly. And speaking of defense, they seem to have a fortress of a balance sheet. I keep seeing this term Basel III endgame.
Right.
That's the standard for how much capital a bank has to hold in reserve. U.S. Bank has built its main capital ratio, the CET1, to 10.8%.
And the requirement was, what, 10%?
Their target was around 10%, so they are significantly overcapitalized.
Which explains why they're restarting share buybacks.
Yes, they expect to buy back $100 to $200 million in stock next quarter. It's the ultimate signal of confidence. It means they have cash to spare.
So let's look forward. What does the crystal ball say for 2026? What's the guidance?
The outlook is surprisingly sunny. They're guiding for total net revenue growth of 4 to 6% in 2026.
Okay.
And remember that operating leverage we started with, they expect another 200 basis points of that.
So the gap between making money and spending money gets even wider.
Exactly. And mid-single-digit growth in fees. But one thing that stood out to me was their physical footprint strategy. You hear digital transformation, and you assume branches are closing.
Right. I honestly can't remember the last time I went into a physical bank branch.
Well, people who need complex advice still do. Small business owners, wealthy families. U.S. Bank isn't killing branches, they are evolving them. They mention renovating branches in Denver into multi-client hubs.
Hubs, so not just a teller window and a sad bowl of lollipops.
No. These are centers where you can meet a business banker, a wealth manager, a mortgage specialist, all in one place. They're closing the small in-store branches and investing in these hubs.
It's a quality over quantity strategy.
For sure. They want the physical locations to be places where high-value conversations happen, not just transactions.
And what does all this say about the economy itself? Because a bank is really just a mirror of the economy it serves.
According to their data, the soft landing actually happened. Yes, they noted that delinquencies are stabilizing. The consumer is holding up. The resilience is there.
So if a bank this size says the landing is soft, that's a very good sign for 2026.
It suggests the average American and the average business are adjusting.
So let's wrap this up. We started by calling U.S. Bancorp the boring bank that isn't. I think the evidence holds up. They're massive, but they're acting surprisingly nimble.
Buying trading firms, testing stablecoins, growing loans, and doing it all while keeping a very tight leash on expenses. It's a masterclass in disciplined growth.
For you listening, if there's one takeaway from this deep dive, I think it's the concept of interconnectedness.
That really is the key word. U.S. Bank realized being just a lender isn't enough anymore. They want to process your payments, manage your wealth, handle your IPO.
Maybe even custody your crypto assets. By deepening these relationships, they insulate themselves.
It's about building a moat, a really wide, diversified moat around their business. They're trying to become indispensable to their clients.
And I'll leave you with this thought, something to mull over. If a traditional, highly regulated, boring bank like U.S. Bancorp is successfully running cross-border stablecoin transactions, Are we closer to the mainstreaming of digital currency than the headlines suggest?
It's a great question. When the innovators do it, it's an experiment. When the banks do it, it's infrastructure.
And what happens to the smaller community banks that can't afford to build that infrastructure? Do they get left behind? That is a deep dive for another day. Thanks for listening, and we'll catch you next time.